Right then, hello everyone, and we are at the end of another week of trading. So we're back again for another week in review. We'll start off with the calendar. We'll jump across to a few charts now in a minute. Lacking a bit in high impact data to start the week. We see on Monday business climate out of IFO business climate out of Germany 9 a.m. didn't really move markets too much. Into Tuesday, no high impact data of note on Tuesday. Come into Wednesday and see a CPI print out of Australia. Didn't really budge. The Australian dollar didn't move markets too much. The central bank, the RBA, have gone on hold. They said that they're going to allow the interest rate hikes that they have already done to take their effect on the economy. There's not an exact, cut interest rates or hike interest rates. Reaction is then straight away. There's a bit of a lag and a bit of a turnaround time in order to allow these things to take effect. So they have raised interest rates, obviously quite substantially along with the rest of the world, and they are going to allow that to take effect. And you can see it is kind of taking effect as of now. Previous 7.8% consensus was 6.9%, but the actual ended up coming in at 7, so slightly higher than consensus. Only 0.1% higher, which isn't too much of an issue. Still nearly a full percent drop from the previous figure itself. So market it's the expected reaction, or what they would expect to happen and what they want to happen is happening. Whether it's 0.1% above or below consensus doesn't really change the picture. The reaction they're hoping for is happening, and they're obviously going to then allow that, or hope that continues, maybe at a more aggressive pace or the same pace over the coming quarters ahead. But obviously we'll cross that bridge when it comes to it at the end of Q2. But yeah, central bank on hold, allowing their interest rate hikes to take effect. These consumer confidence figures out of Germany didn't really matter too much. They're negative, slightly positive in terms of the consensus, but still minus 25.7. Still not great. Didn't really move markets too much. And then on to the US date of the week. So durable goods orders, you can see manufacturing numbers out of the US 1:30 p.m. on Wednesday. Actual 3.2% versus a consensus of 0.7 and a previous of minus 1.2. So pretty strong manufacturing figures out of the US on Wednesday. Leads us into Thursday, which is the GDP figures out of the US for Q1. Consensus 2%, actual 1.1%. Now it's a big miss on expectations, but it's in line with the Atlanta Fed's forecast. No surprise in terms of that. Plus still 1.1% growth in terms of a quarter it's still not bad, is it? It's gone from 3.6 Q3 of last year into 2.5 Q4 of last year into 1.1% for Q1 of this year. So it is trending lower, which is obviously not ideal, but still 1.1%, still pretty strong growth over the course of one quarter. So nothing too much to be worried about there just yet. Obviously, if that trend then continues and it gets back towards zero and you start printing negative growth, well then that's something to be worried about then. But we're not there yet. We'll cross that bridge when it comes to it. Manufacturing numbers on Wednesday still remaining strong. Right. Brings us into today. A couple of still got PCE, core PCE, the Fed's preferred metric of inflation at 1:30 today, right? Which is consensus for 0.3% in line with the previous month's plus 0.3% as well. But we did have quarterly figures of this number out yesterday, which were slightly higher than anticipated. Right? We then have jobless claims out of the US yesterday, also at 1:30. That showed a slight miss on expectations for jobless claims, which is then a positive for the labour market. So the labour market still remains strong. Manufacturing numbers here are strong. GDP, albeit below consensus, still relatively strong. But that suggests that we get some positive inflation figures, judging off the back of the quarterly figure yesterday. Definitely is potential for some upside in terms of the consensus, which means then the Fed need to keep the foot on the gas. Manufacturing is still okay. Growth is still okay, the jobs market is still okay, and inflation still rising faster than they would like it to. Means they need to keep the foot on the gas, need to keep hiking interest rates, and hopefully those interest rate hikes that they have already done can continue to take effect. Couple of other things, some growth figures out of the Eurozone, kind of negative figures, certainly in terms of the consensus, but the main focus of that GDP quarterly figure out of the Eurozone 10 a.m. this morning did avoid a contraction, still remains 0.1%, albeit slightly below consensus, still 0.1%, no contraction there in relation to the Eurozone, which is good, which is a good sign, and obviously a positive for the Eurozone as a whole. CPI out of France was the kind of one outlier this morning in terms of beats on consensus, 5.9 versus 5.7. So inflation still kind of rising in France, which then leads us into the CPI print from Germany. 1 o'clock today. Does that shake up markets too much? Maybe not half an hour before the US inflation, but we also have had, we also are pretty sure what we're going to get out of the ECB. We're going to get another 25 basis points next week, which we will get to in a minute. Then another 25 basis points in July, another 25 basis points in June and July. Sorry, I skipped the month of June. Another 25 in June, another 25 in July, and then that is likely to be them done. This inflation print probably isn't going to change that. So does it give us much impetus, much direction in markets over the course of today? For me, probably not. But I've been wrong before. I will be wrong again, but in my opinion, probably not. But obviously we'll cross that bridge when it comes to it at 1 o'clock today. In the markets today then, or in the markets this week, and the main movements have not come from the economic calendar. Main movement came on Tuesday and then Thursday as well. Tuesday there was reports of the First Republic Bank in the US potentially nearing or on the brink of collapse. The bank reported a massive dip in deposits, right? Massive dip in deposits, money being put in the bank, and they also then suggested that they were going to try and offload $100 billion worth of assets in order to raise funding to help the bank function. Reports then that the US government were then going to take control of the bank and help provide support to the bank, which is natural in terms of these banking problems, which then reignited fears of a banking crisis. It then caused markets to sell off across the board. You can see the S&P, the Dow, and Nasdaq all having downside across Tuesday. Russell also having downside across Tuesday. Saw a rally in the VIX on Tuesday, downside across, a little bit of downside in the DAX and then the FTSE as well, but mainly these US indices seeing downside over the course of Tuesday, which then continued on into Wednesday. The 50% decrease in the price of the stock itself on Tuesday, then a further 30% then on Wednesday. So massive downside across the stock, reignited fears of a banking crisis in the US. We then come into Thursday. We had some positive earnings, or after positive earnings out of the US over the course of this week. Some positive earnings out of some banks, and then not much chatter about the First Republic Bank. So back end of this week, as of yesterday, solid upside across the board in US indices. Russell kind of lagged behind, but you can see certainly the Nasdaq, the Dow Jones, and the S&P across here. Very strong upside over the course of yesterday, off the back of some positive earnings, off the back of banking fears, banking crisis fears being alleviated. Caused some upside in stocks yesterday, which started in the morning and was a one directional move the entirety of yesterday, which is not something you see too often. Pretty difficult to trade. So when you're sort of halfway up those moves or sort of towards the highs, but solid upside over the course of yesterday. Have given back some of those gains this morning, but that is natural. That's to be expected once you see an aggressive move like that. Brings us on to the US dollar. Pretty strong across a positive week in terms of the US dollar. You can see pretty choppy across euro dollar and cable. Euro dollar down, bit of dollar strength off the back of those fears on Tuesday, which we were just talking about. Bounced back on Wednesday off the back of some hawkish commentary from the ECB. The cable kind of followed that as well, but really just choppy trading conditions across the board for the majority of this week. Come to dollar Swiss, it's pretty choppy in slightly bigger range, albeit a bit of upside over the course of this week. Still pretty choppy. Kiwi pretty choppy. Bit of downside in the Australian dollar. Still, that's really the one with kind of maybe the better direction over the course of this week. Couple that with dollar CAD. Right, dollar CAD upside off the back of some downside in oil. You can see the downtrend in oil has kind of kicked back in, and you can see over the course of the last couple of weeks, strong downside in oil. Obviously, the correlation between oil and the Canadian dollar obviously puts pressure on the Canadian dollar as well. Dollar CAD then trends higher. So dollar CAD on the Aussie, really the ones with clear direction over the course of this week, which shows it's not really a US dollar driven week. It is more of a a week driven by the other currencies. Dollar yen, you can see here solid upside across dollar yen. Expected reaction, that is off the back of a dovish interest rate hike this morning. You're not going to buy it up at these highs now, are you? So if you missed the boat on that one, it's pretty tricky to trade 4 a.m. in the morning if you are trading the London session, but that's the expected reaction from a dovish central bank. And you can see a bit of downside across the Japanese yen. You can see then a bit of upside across the Nikkei. Obviously this morning, see the Bank of Japan interest rate decision where there was some chatter in markets that they would alter monetary policy, or at least give us an update on when they may alter monetary policy in order for the removal of yield curve control, which they did mention over the course of last week. A potential removal of yield curve control would obviously send then yields higher, which would raise interest rates in the country, which obviously has not happened for a while, which would spark some upside in the Japanese yen. So that did not materialize. The fact that they did not do that, plus they mentioned they downgraded growth forecast from last week. They also suggested interest rates should remain the same or even potentially lower. So a couple of dovish comments, dovish motions out of the Bank of Japan over the course of this morning sparked a bit of upside in the Nikkei and a bit of downside in the yen, which is the expected reaction to those sort of comments. Brings us on into next week. See, next week we have manufacturing PMI out of the US next week. Some positive durable goods orders this week. Is that a kind of front runner for the manufacturing sector next month? Maybe, potentially. We'll obviously cross that bridge when it comes to it over on Monday. Tuesday into the RBA. So you can see the RBA not expected to hike interest rates, expected to hold firm, as we did mention earlier on. Does that inflation print change anything this week? I would say no. So nothing probably to see there. Probably a bit of a non-event. Couple of things of note out of the Eurozone. A CPI print out of the Eurozone and some labour market figures out of the Eurozone. But again, does that really change what the ECB are going to do? 25 basis points next week, 25 in June, and then 25 in July. Do those numbers really change much? I would argue they probably don't. The Fed as well, we're expecting 25 basis points out of the Fed. What would be interesting to see is their future guidance. Jerome Powell was saying earlier on in the week to probably expect 25 basis points at this meeting and then 25 basis points at the next, and then they will kind of cross that bridge when it comes to it at that point in time. Do we get a further update next week at 7 o'clock? That will be what markets will be watching out for. We've not got any economic projections, no dot plots, none of that sort of stuff. Just an interest rate decision, a statement, and then obviously the accompanying press conference at 7:30 p.m. later on that evening. Bring us on to the ECB then. ECB on Thursday. Obviously we've mentioned 25. Bring us to a terminal rate of 3.75%. Probably not a bad thing, as they have not hiked they shouldn't hike the economy into a recession, as they have not risen interest rates at the same rate as some of the other countries. Brings us on to non-farm payrolls to conclude a busy week next week. Labour market still resilient, still strong in the US. So consensus is for 181 jobs to be added and a slight uptick in the unemployment rate, but that will not be too displeasing for the central bank, as a slight raise in the unemployment rate is not a bad thing in order to get inflation under control. But I'm going to wrap it up there then. That is it from me. Bank holiday on Monday, 2 bank holidays in a row in the UK, so be careful of low levels of liquidity, low levels of volume, low volumes within markets on Monday. Might be slightly tricky trading conditions across the board, certainly in that European session on Monday morning. So be careful. Maybe keep your money in your pockets first thing on Monday morning. Ease yourself into the week, and then on Tuesday we'll be back for a shortened week of trading. Well, that's it from me then, folks. Enjoy the long weekend, and I'll speak to you all again next week.